I want to start with a sentence that Jerome Powell said at what was almost certainly his final press conference as chairman of the Federal Reserve. A reporter asked him directly whether the United States economy was entering stagflation. And Powell said this: "I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we are in. What we have is some tension between the goals. We are trying to manage our way through it." Write that down. Not the sentence itself, the gap between that sentence and the data that exists on the other side of it. Because that gap is the most important thing a central bank chair has communicated in a press conference in this decade. Not what Powell said, what he was not able to say. The FOMC held rates at 350 to 375% today, April 29, 2026. The decision was unanimous in outcome but not in direction. 3 members dissented, not because they wanted to cut, but because they wanted the policy statement language changed to reflect that rate hikes are back on the table. The statement retained its easing bias. The language that says the committee will carefully assess incoming data in considering the extent and timing of additional adjustments. That easing bias language is what markets have been hanging their rate cut hopes on for months. Several FOMC members want to remove it. Powell acknowledged publicly at today's press conference that the center is moving toward a more neutral place. Neutral means the next move is equally likely to be a hike as a cut. That is not a small shift in language. That is the Fed telling you, in the most carefully calibrated diplomatic language available to a central bank, that the scenario it spent 2 years hoping to avoid has arrived. Inflation above target, growth collapsing, and a policy response that makes both worse simultaneously. That is the definition of the trap. And Powell spent his final press conference refusing to name it while describing every one of its features. I have been watching central banks communicate through the gap between what they say and what the data requires for over 40 years. And what I'm going to show you today is not an interpretation. It is a mechanical decoding of the specific language the Fed used today, the specific data that language was written to obscure, and the specific implication of that gap for gold, for bonds, for the dollar, and for every asset class that the Fed's next move determines. Subscribe now. Here is the data that Powell was not able to say out loud today. Write this down because these numbers are the definition of the trap, and they exist in the official government data regardless of what language a central bank chairman uses at a press conference. The first number is 3.3. That is the year-over-year headline CPI print for March 2026, released last week, the highest annual increase since May 2024. Month-over-month, headline CPI rose 0.9% from February to March, not an annualized rate, an actual monthly increase. At that pace, annualized inflation is above 10%. The March reading was driven primarily by energy. Oil above $100 per barrel from the Hormuz closure flowing through to gasoline prices, which exceeded $4,000 per gallon nationally for the first time since 2022. Core PCE, the Fed's preferred inflation measure, stands at 3.1% year-over-year with a 0.4% month-over-month print. 16 out of 19 FOMC members see upside risks to their core inflation forecast, not downside, upside. Meaning the internal consensus of the institution is that inflation is more likely to go up than down from here. The second number is 0.7. That is U.S. GDP growth in the fourth quarter of 2025, down from 4.4% in the third quarter. Manufacturing has been contracting for 9 consecutive months. Unemployment is at 4.4% and rising. 14 out of 19 FOMC members see downside risks to growth. The same institution that sees 16 out of 19 members worried that inflation goes higher simultaneously sees 14 out of 19 members worried that growth goes lower. 16 members pointing one way, 14 members pointing the other. That is the internal map of the stagflation trap, drawn by the institution whose job it is to escape it, distributed in the summary of economic projections, and read by almost nobody outside the bond market. The third number is 1.03 trillion. That is the annual interest payment the United States government is making on its $39 trillion national debt. For the first time in American history, the interest payment on the debt exceeds the entire defense budget. The government is spending more to service existing debt than to fund the military that defends its borders. At the current Fed funds rate of 3.50 to 3.75%, that interest bill grows with every Treasury auction. The United States must refinance $9.2 trillion in maturing debt this fiscal year. The arithmetic of sustaining rates high enough to fight inflation while simultaneously servicing $39 trillion in debt at those rates is the third wall of the trap. It is the wall that prevents the Fed from raising rates the way Volcker did in 1979. It is the wall that the three dissenting FOMC members who want two-sided language are pressing against without fully acknowledging what is on the other side of it. 16 members worried about inflation, 14 worried about growth, 3 wanting to add rate hike language to a statement issued against a backdrop of $1.03 trillion in annual interest payments. The trap does not care about the language. The trap is mathematical. Now let me tell you what Powell said between the lines at today's press conference, because the art of reading a Fed statement is understanding that every word is chosen with a precision that makes legal documents look careless. The statement retained the phrase carefully assess incoming data, the evolving outlook, and the balance of risks. That phrase is the easing bias. It signals that the next move is more likely to be a cut than a hike. Powell has retained that language today despite the fact that 3 members want it removed and despite his own acknowledgement that the center is moving toward a more neutral place. Why would he retain easing bias language that he himself is describing as under pressure? Because removing it today, in Powell's final meeting, with Kevin Warsh's Senate Banking Committee confirmation vote happening simultaneously in a separate building on Capitol Hill, would have been read as a policy statement about the incoming chair's direction. It would have been read as Powell saying, on his way out the door, that the Fed is moving toward rate hikes, which would have set a specific framework that Warsh would either have to confirm or reverse at his first meeting in June. Powell chose ambiguity over clarity. He retained the language. He described the pressure on the language. He let the market read the gap. That gap between retained easing bias language and a center moving toward neutral is the most important sentence in today's press conference. It is the sentence where Powell told you, without saying it directly, that the next move is no longer clearly a cut. It may be a hold that becomes a hike. And in the specific fiscal configuration I described, $39 trillion in debt, $1.03 trillion in annual interest payments, $9.2 trillion to refinance this year. A hike is the option that is mathematically most catastrophic, which is exactly why the 3 members who want two-sided language are the most important signal from today's meeting. They are the members who believe the inflation risk is so serious that they are willing to press for language that acknowledges rate hikes, even knowing what rate hikes at this debt level would do to the government's interest bill. The dissent is not about a 25 basis point technical adjustment. It is about which catastrophe the Fed is willing to accept: faster inflation or faster fiscal collapse. There is no option that avoids both. Now I want to show you the historical record of what happens when a central bank finds itself in this exact configuration, because the pattern exists and it is documented with specificity. The closest parallel in American monetary history is not the 2008 financial crisis. The GFC was a demand shock and a credit crisis, and the Fed had the tools to address it with rate cuts and balance sheet expansion because inflation was falling when the crisis hit. The closest parallel is 1979. The FOMC under Arthur Burns had spent years trying to thread the same needle Powell described today, managing the tension between the goals, calibrating policy to avoid both too high inflation and too slow growth. The result was the worst inflation outbreak in American peacetime history. When Paul Volcker took the chair in August 1979, he inherited an economy where the Fed had spent years refusing to say the word stagflation while describing every one of its features. Sound familiar? Volcker's response was unambiguous and brutal. He raised rates to 20%. He broke inflation. He also caused the worst recession since the 1930s, with unemployment peaking at 10.8% in 1982. And he was able to do it because in 1979, the national debt was $830 billion. At 20% rates on $830 billion, the annual interest cost was $166 billion. Painful, manageable, not existential. Today, at 20% rates on $39 trillion, the annual interest cost would be $7.8 trillion. The entire federal revenue for fiscal year 2025 was approximately $4.9 trillion. The Volcker option does not exist in 2026, and this is the fact that makes today's FOMC meeting different from every previous meeting where a Fed chair described tension between the goals and declined to use the word stagflation. Previous Fed chairs who declined to use the word had access to the tools that could resolve the tension. Powell and Warsh after him do not. The tools have been deployed. The balance sheet is $6.5 trillion. The debt is $39 trillion. The interest payment is $1.03 trillion annually. The only remaining tool is time, and time in a stagflation trap does not resolve the tension. It deepens it. Let me now give you the specific language from today's FOMC statement that tells you exactly where the Fed believes it is in this trap, because the language is precise and it is being decoded in real time by every institutional desk that manages sovereign bond risk. The statement said that uncertainty about the economic outlook remains elevated. That phrase, uncertainty about the economic outlook remains elevated, is new. It was not in the January statement at that level of emphasis. It represents a formal acknowledgement that the FOMC's own internal models are producing outputs with ranges wide enough that the committee cannot confidently state the direction of the next policy move. When a central bank says uncertainty is elevated in a policy statement, it is telling you that the models that normally guide policy have lost predictive power. And when the models lose predictive power, the institution falls back on principles. The principle that is being debated inside the FOMC right now between the 16 members who see upside inflation risk and the 14 who see downside growth risk is the same principle that was debated inside the FOMC in 1979. Is the primary mandate price stability or maximum employment? In normal times, the Fed pursues both simultaneously. In a stagflation trap, pursuing one actively harms the other. The statement also retained the phrase, attentive to the risks to both sides of its dual mandate. That phrase is the two-sided acknowledgement. The Fed is watching inflation risk and employment risk simultaneously, watching both, addressing neither, because addressing either one with the tools available makes the other worse. This is not a temporary paralysis. It is a permanent feature of the trap until one of the walls moves. And in the specific configuration of 2026, the walls that would allow the trap to resolve on its own, falling oil prices reopening the Fed's path to cuts, a recession severe enough to break inflation on its own, are both deeply painful, and neither is arriving on a schedule the Fed can plan around. Here is where all of this connects directly to gold, because the mechanism that makes stagflation the most powerful structural environment for gold in monetary history is not the inflation alone. It is the combination of inflation and the inability to fight it through conventional monetary tightening. In the 1970s, stagflation, gold rose 2,300% from Nixon's gold window closure in 1971 to the peak in January 1980. Not because inflation alone was high, because the Fed could not bring rates to a level that convinced the market the dollar would hold its value without simultaneously destroying the economic base the dollar was supposed to represent. The market looked at the Fed's impossible position, saw that no conventional response could resolve it without catastrophic side effects, and priced the dollar's debasement in advance through gold. In 2026, the IMF published its April World Economic Outlook this week under the title Global Economy in the Shadow of War. The report projects global growth at 3.1%, below recent outcomes and below pre-pandemic averages. It describes risks as decisively on the downside. A prolonged conflict, deeper geopolitical fragmentation, and renewed trade tensions could weaken growth and unsettle markets. The IMF is describing the same environment the FOMC statement describes in more careful language. And the combined signal from both institutions, released within hours of each other today, is that the global economy is in a configuration where the conventional tools for addressing either inflation or growth weakness are constrained by the same structural forces: high debt, an oil shock that keeps inflation elevated, geopolitical fragmentation that reduces the efficiency of the monetary transmission mechanism, gold's institutional price targets, $6,300 from JP Morgan, $5,400 from Goldman Sachs, $6,000 from Deutsche Bank, were set before today's FOMC meeting. They were not revised after the January Warsh shock, They were not revised after the March correction. They have not been revised downward to reflect today's stagflation confirmation, because the institutions that set those targets understand that today's FOMC statement is not a new development in the structural gold thesis. It is the official confirmation that the structural gold thesis is correct. Now, let me be specific about the two signals I am watching after today's meeting that will tell me when the stagflation trap enters its most acute phase, because the confirmation of the trap is not the same as the resolution of the trap. And the resolution, when it comes, is what produces the move that JP Morgan's $6,300 target reflects. The first signal is the June FOMC meeting under Kevin Warsh. Warsh chairs his first meeting on June 16th and 17th, the date legal experts have called the true drop-dead date for the transition. Warsh has publicly proposed eliminating the dot plot, the quarterly interest rate projection chart that markets rely on for forward guidance. He has proposed holding fewer press conferences. He has proposed a smaller balance sheet. Every one of those proposals, if implemented, reduces the transparency of Fed communication and increases the uncertainty premium that markets require to hold long-duration dollar assets. When central banks reduce their communication transparency in a stagflationary environment, the gold market responds by pricing the unknown higher, not lower. If Warsh's first statement eliminates the dot plot and signals reduced forward guidance in a meeting where the underlying data still shows 16 out of 19 members concerned about upside inflation risk, the market will read that as a Fed that is less committed to price stability, not more, regardless of what the accompanying language says. Watch the June meeting statement for dot plot and press conference language changes. The second signal is the April core PCE print, due to be released shortly. March headline CPI came in at 3.3% year over year with a 0.9% monthly jump. If the April core PCE, which the Fed targets directly at 2%, prints at or above 3.3%, the gap between the Fed's stated 2% target and the actual inflation level becomes so wide that the easing bias language retained in today's statement becomes politically and institutionally untenable. A third consecutive month of 0.4% or higher core PCE monthly prints removes the option of reading the inflation as transitory. It removes the option of retaining easing bias language without credibility damage to the institution, and it removes the option of waiting patiently for conditions to improve without acknowledging that conditions are not improving. Watch the April core PCE. If it prints at 3.3% or higher, the language in the next FOMC statement will change, and when that language changes, the market will price the two-sided reality that 16 of 19 FOMC members already see. Today was Powell's final press conference. He said the word stagflation is reserved for more serious circumstances. He said what he had to say. The data said what it had to say. And the gap between those two things, measured in GDP growth below 1%, inflation above 3%, 3 dissents pushing toward rate hike language, and an IMF report calling global risks decisively on the downside, is the most important signal from today's meeting. Not the rate decision. Every informed participant knew the rate decision before the meeting started. The signal is the language that was retained under pressure, the language that is moving toward neutral, and the data that makes neutral the most optimistic possible characterization of the position the Federal Reserve finds itself in on April 29, 2026. Watch the June Warsh meeting, watch the April core PCE, and understand that today's press conference was not a communication about monetary policy. It was a communication about the limits of monetary policy. In 40 years, I have watched the gap between what a central bank says and what the data requires eventually close. It always closes in the same direction, away from the currency and toward the asset that has no central bank, no press conference, no carefully calibrated language, and no trap it cannot escape. There are two types of investors watching today's FOMC press conference. The first type heard Powell say he reserves stagflation for more serious circumstances and concluded the Fed has the situation under control. They read the rate hold as stability. They read the retained easing bias as confirmation that cuts are still coming. They are not tracking the 3 dissents. They are not reading the 16 out of 19 members who see upside inflation risk against the 14 out of 19 who see downside growth risk. They are not calculating what $39 trillion in debt at the rates required to break 3.3% inflation would cost in annual interest payments. They will discover the gap between Powell's language and the data's language the same way investors in the 1970s discovered it. Not in the press conference, in the price of everything they buy, in the value of the savings they hold, and in the performance of the assets they chose not to own when the stagflation trap confirmed itself in the official language of the institution responsible for preventing it. The second type of investor listened to the same press conference and decoded a different message. They heard Powell say the center is moving toward neutral and understood that neutral in 2026 means the next move is no longer clearly a cut. They heard him retain the easing bias language and understood that he retained it not because it reflects the committee's true balance of risks, but because eliminating it in his final meeting would have set a framework his successor would have had to navigate from day one. They heard him refuse the word stagflation and understood that the data he was declining to describe with that word is the data that central bankers decode when they want to understand where an economy actually is, rather than where an institution needs to say it is. The trap is confirmed. The June Warsh meeting will either resolve that gap with new language or widen it by removing the communication tools that allow the market to read the gap at all. Watch the June statement. Watch the April core PCE. The gap always closes. The only variable is the asset class that benefits when it does.